Welcome to the Canadian Investors Course Session 4, Finding Equities to Buy or Sell. As with all the previous sessions, please note page 2, Terms of Use and Disclaimer. We recommend you read it. Moving right along. Page 3 has a cartoon with a bear with an investor held between its claws, and it's about to digest them because bear markets eat your wealth. Today's session is on finding stocks to buy or sell. We're going to discuss the balance sheet and how it affects you. We're going to talk about fundamental analysis and technical analysis. So, remember ToolCorp from session 3? Well, now we're going to look at ToolCorp's balance sheet. And we're going to compare it to your household balance sheet. And so you'll see how really these two things relate very closely. If you don't know what a household balance sheet is, you need to talk to a trusted wealth professional, because you really should. It's the fundamental budgeting tool for your family, just like it's a fundamental budgeting tool for a business. So, let's get into it a little bit. You see your family income here. You have a salary of $100,000 a year. You get some interest income from perhaps some investments that you have, GICs or whatever. You get some dividends from some stocks you own. So your total income is $115,000. Now, what has to come off of that income? Well, all your living expenses, your mortgage, your food, clothing, utilities, auto transportation, property taxes, vacations, and discretionary expenses. And let's say they add up to $60,000. So now, 115 minus 60, you're at 55. By the way, what did we miss out? We missed out taxes. Oh, they're at the bottom. So we're good. So now, we want to make some contributions to savings, because after all, the object of the exercise of this course is to teach you to invest. If you're going to have something to invest, you've got to save some money. If you're going to save some money, presumably you're going to want to do it in the most tax efficient way possible. You're going to look at your RRSP to save for your retirement, your RESP to maybe save for your children's education, and don't forget CRA is going to want some money. They don't like the fact that we're putting income taxes at the bottom. They'd like to see income taxes right above that mortgage line. But this is where we're putting them anyway. So we've got $60,000 in expenses. We've got $50,000 in savings and taxes, and that leaves us $5,000. Now, $5,000 could go into the savings account. It could go to pay down debt, or you could blow it at fancy restaurants. You decide. Okay. Now, let's look at ToolCorp. And how does their cash flow statement look? Well, they got net sales of $500,000, because these are all, the 1,000 part is missing in all cases, or millions. Oh, it's millions in this case, so 500 million. Cost of goods sold is 380 million. Gross profit, if you subtract sales from cost of goods, is 120 million. And then, of course, you have to subtract the operating expenses. For your home, it was your mortgage and so on. Here, it's operating costs, selling costs, salaries, depreciation. So that reduces the operating profit down to 70 million. And of course, you have to take out interest expenses before tax. So there's another 20 million out, so you're down to 50. Companies have to pay taxes too, so you're down to 40. You got some miscellaneous extraordinary items maybe that pump it up a little bit, so the net income's 45 million. So you see how the company balance sheet looks an awful lot like the company cash flow statement, looks an awful lot like your family balance sheet. And of course, the net income goes into shareholders' equity. It can be positive in this case, or it can be negative. So in some cases, it's negative income, so it comes out of the shareholders' equity. But in this, in this case, they sold some used machinery and land, and so they had a little bit of, that was the extraordinary items. And let's forget about EBITDA, which we'll talk about a little later on. Now, let's look at this thing again. So your personal household net worth statement. So we're going back to your personal thing again. So your short-term, your assets, short-term cash, you got $5,000. In money market and T-bills, you got $20,000. You got $100,000 in bonds and GICs. That's where some of that interest income came from. Then you got some mutual funds for $50,000, $100,000 of equities, $500,000 in your house. This is an old statement. I guess that should be $1 million nowadays. Other assets, you maybe have cars for $40,000 in value, a bit of jewelry. So your total assets are, let's say, $825,000. Now, on the liability side, you got some credit cards, you got a home equity loan, maybe a car loan, maybe a mortgage. Your total liabilities are $275. So if you look at your assets of $825 minus your liabilities $275, you get your net worth, which is $550,000. Now, let's go over and look again at the company balance sheet. So we had your personal budget, if you like, looks like a company income statement. You got the company, you got your personal balance sheet, and you got a company balance sheet. So let's look at the difference. Well, in the company, you got current assets of cash, short-term investments, net receivables, and inventory for about $110 million. Then you got long-term investment in property, plant, and equipment for $95 and $240 million. You had goodwill, which is a number that is, most people when they're buying a company, they count that to zero because it's sort of difficult to determine. But in this case, it's listed as worth about $150 million. Some intangible assets like patents and so forth for $20 million. Deferred long-term assets like prepaid expenses and so forth for $30 million. So you got a total on the asset side of the balance sheet, $645 million. On the liability side, you've got accounts payable for 20, short-term debt for 30, current liabilities of 50 million, giving current liabilities of 50 million, and then you've got long-term debt and other liabilities and deferred long-term liability charges like taxes and so forth. So the total liabilities of 200 million, and shareholder equity added to that 445 million, so 645 million, because the shareholder equity is what balances out the balance sheet. So in other words, we had total liabilities of 200 million, we've got total assets of 645. A balance sheet, because it's called a balance sheet, has to balance. 645 has to be the same both sides, and so the shareholder equity is the difference between the liabilities and the assets. Now, if you look at the shareholder equity in a little more detail, you've got your common stock for 400 million. You got retained earnings from before. Remember the earnings statement, 45 million. So total shareholder equity is 445 million as the assets minus the liabilities. Net tangible assets are 275 million, which is the assets minus liabilities plus intangibles and goodwill. So that's where that goodwill thing pops in there, because the tangible assets remove the goodwill. So 40 million shares outstanding, last trade at $24.50 a share. Let's go to the next slide. And let's look at fundamental analysis. The idea of fundamental analysis is to determine whether the company is healthy. Does it have good financials? Does it have decent liquidity ratios, profitability levels, and leverage ratios? You want to be able to compare this company to other companies to determine whether this is the better buy or some other company is a better buy. So you use your financial ratios as a deciding factor. It's sort of like going on TripAdvisor and deciding which hotel you want to use. You want the one with the best reviews. Well, this one is really a sort of form of reviews of companies using financials as a criteria. And it determines whether it's a good buy or not. In other words, is the company solid, and is it healthier than some other company? It's a good starting point. Now, moving to the next slide. Some of the ratios that we use, we'll go through a whole collection of these ratios. So ratios used in equity investing. Liquidity ratio tells you how easily a company can pay its debt over the next 12 months. So you use a current ratio. The current ratio is current assets divided by current liabilities equals short-term liquidity. 2 to 1 is good. Anything higher than that, not so great. Is better. So 110 over 50, 2.2, not bad. So the debt, let's look at debt to equity. That's the total debt taken into account. So that's total liabilities times 100 divided by shareholder equity to give a percentage. So the debt to equity is 44.9%. It's sort of a little bit the reverse of that current ratio. Moving to the next slide. So let's look at some profitability ratios, see how good the company is at making money. The operating profit ratio is the operating income times 100 divided by net sales to give again a percentage. So the operating profit ratio here is 70 is the operating income times 100 divided by 500 is 14%. So that means the operating profit on the company is 14%. The net profit ratio is the net income after taxes times 100 divided by net sales, in this case 8%. So generally the higher the number, the better. And you want to compare it to previous year's returns in other companies in the same industry to determine whether it's a good number or not. Because if the whole industry is at 5% and you're at 10, clearly you're doing much better than the industry. Yours is probably the company to buy. And the inverse counts too. Return on equity is a very good profitability measure. So what's, if in other words, that's, I put up this much money, what's the return I'm getting on my money? In this case, that's the net profit margin. Well, not in this case, in all cases, the net profit margin times 100 divided by shareholder equity. And in this case, it's about 10.1%. Well, the question is, would you be happy with a 10% return on your investment? Most people would. The price to book value is another useful term, but again, you want to compare it to others in the industry. If it's a high profit industry, 10% may not be good at all. In a low profit industry, like the retail industry, 10% might be excellent. So anyway, you have to look at it as a tool to compare to others in the industry and to other industries. Price to book value is the liquidation value. That's not such a useful tool, but it's one ratio that people consider too. It's the share price divided by total shareholder equity minus preferred equity divided by total outstanding shares. Typically, you're looking for a number around 2 times. Price to book value here is okay. Some of the more popular ratios that people use and ones that you'll see all the time are earnings per share. So that's net profit divided by the number of shares outstanding. And that comes up with a dollar number. So, you know, in this case, it's $1.12 per share is the earnings per share. And again, you compare that to others in the industry, and you compare it to previous and future financials for the company. And the price earnings ratio is probably one of the most used tools in equity investing. That's the price of the stock divided by earnings per share. It gives you a number. Now that number moves around, and we'll talk about that quite a lot later on, because you'll hear about earnings expansion and earnings contraction. When we're talking about that, we're referring to whether the price to earnings ratio is going up or going down because of market forces. Then there's the dividend yield, which is the dividend times 100 divided by share price. This is something which people who are income investors look at closely. So for example, you want to buy an insurance company that's got a nice dividend on it. You want to know what kind of rate of return you're going to get on the stock while you own it, in addition to whatever growth or lack of growth you might get from the stock itself. So in this case, this company doesn't pay a dividend, so it's nothing, because it's 0 times 100 divided by the share price, which was $24.50. Now, we're coming back to EBITDA. That's that term that we mentioned on the early slide. EBITDA is operating profits. That's earnings before interest, taxes, depreciation, and amortization. And this is a valuable tool, but it's a tool that you have to understand correctly. And don't be blinded by it, because very often analysts will talk about EBITDA instead of earnings per share. They're taking all the expenses out. So what do investors watch? Well, they watch the ratios they watch ratios and they use them to monitor the overall market. For example, we look at historical PEs on the S&P and compare them to current ones to determine whether the market is cheap or expensive. We look at the S&P before and after inflation using ratios. We look at the dividend yield for markets as well as the dividend yield for individual stocks. We look at market index price to sales so that we get a feel for whether the market is buoyant or whether the market's overvalued in relation to sales. And finally, we look at market capitalization in relation to the economy or the general, the gross domestic product, GDP. Now, moving on to technical analysis. What we talked about before was fundamental analysis. That's the fundamentals of the company. What do the financials look like? How do they look in relation to other companies to determine whether the company has good value or not, to determine whether the market is good value or not. Now we're going to look at technical analysis. This is the market telling us what things look like, ignoring the individual, whatever fundamentals are going on. Technical analysis is a trading tool employed to evaluate securities and attempt to forecast their future movement by analyzing statistics gathered from trading activity, such as price movement and volume. Price movement is the most popular form used. A technician assumes that price discounts everything. This essentially means the market price of a security at a given point in time accurately reflects all the available information, and therefore represents the true fair value of the security. This assumption is based on the idea that the market price always reflects the sum total knowledge of all the market participants. The second basic assumption underlying technical analysis is the notion that price changes are not random, leads to the belief of technical analysts that market trends, both short-term and long-term, can be identified, enabling market traders to profit from investing according to the existing trend. Some people call technical analysis trend-based investing. There are many forms of technical analysis and many tools available to apply it. Below is just a list of some different types. It's not a complete list either. There are technical indicators, market sentiment indicators, trend and trend lines, bar chart analysis, candlestick chart analysis, point and figure charts, moving averages, price channels, envelopes and bands, momentum and momentum indicators. And then there is the Elliott wave theory, and more. One form of technical analysis, a simple starting point, is moving averages, simple moving averages. So we'll start with a simple moving average approach, and then we'll talk about moving average crosses approach. So you can look at the moving averages on their own, or you can look at how moving averages over different time periods cross each other to give indicators as to what's happening to the stock or the security. So let's start by defining simple moving average calculation number one. Simple moving average is formed by computing the average price of a security over a specific number of time periods. Most moving averages are based on closing prices. A 5-day simple moving average is the 5-day sum of closing prices divided by 5. So in other words, it's the closing averages of each day divided by the number of days. As its name implies, a moving average is an average that moves. In other words, the old data is dropped as new data becomes available. This causes the average to move along the time scale. Below is an example of a 5-day moving average evolving over 3 days. I recommend you be following your slides to follow this. This is a little bit complicated to follow only verbally. And I'm not going to go through all those details. Now, defining a simple moving average calculation number 2. The first day of the moving average covers the first 5. The first day of the moving average simply covers the first 5 days. The second day of the moving average drops the first data point, day 1, and adds the new data point, number 16. The third day of the moving average continues by dropping the first data point, number 12, and adding a new data point, number 17. And in the example above, the prices gradually increase from 11 to 17 over a total of 7 days. Notice that the moving average also rises from 13 to 15 over a 3-day calculation period. And as well, note that each moving average value is below the last price. For example, the moving average for day 1 equals 13 and the last price is 15. Prices the prior 4 days were lower, and this causes the moving average to lag. So in other words, the moving average sort of trails the existing price. Using a 50 or 200-day moving average, this basically just defines which moving averages you're going to use. So for example, let's take gold here. And you can see that back in September 2015, there was a little bit of a blip where gold broke above the moving average, then it failed again and fell down, and then it broke above again. So you'll see that the chart, the actual stock chart, is crossing the moving average from time to time. And in fact, this is a crude indicator that you can start to use to make some of your investment decisions. Now, in this session, we're going to concentrate on a simple yet effective form of technical analysis, the dual moving average crossover. So here what we do is we have two moving averages, a 14-day and a 90-day moving average, and we want to see what happens when they cross. So we take two simple moving average time frames. The first time frame is 90 days, second is 14, and we use a combination of these two to produce a good mix between short and long-term time frame. Now, if we look at that same chart, well, it's a chart of the S&P this time, but it's the same idea. We see the short-term and the long-term moving average, and we'll notice that when they cross, they indicate important events in the market. This is a much more useful tool already to try and give us an indication of when we should buy and when we should sell the S&P 500 in this case. Now, using a monthly time frame, charts give fewer but more accurate crosses and signals. This is a very important tool for a rules-based investment approach, which will be discussed in later sessions. The next few slides go back to 1929. Assume an investor buys at the top of the market at the start of the Great Depression in 1929. If you bought and held during the next decade, you would have lost a major portion of your wealth. However, if you had applied the strategy of rules-based investing using moving averages to warn you of exits and entry points, this might have given you a profit during the 1930 to 40 period and in every subsequent decade. And in fact, in our commentary for this session, we'll talk about this in more detail. It's not practiced by everyone. Technical analysis is shunned by fundamentalists in most cases. Sometimes they'll glance at it. There's a constant conflict in the investment industry between technical and fundamental analysts because their views are significantly different. Now, the following charts use 6 and 13-month moving averages for the Dow since 1929 towards the present time. You'll notice that these crosses are very helpful if when the green line, which represented the short-term moving average, had crossed the red line representing a longer-term moving average later in 1929, if one had sold there, clearly one would have been blessed because you'd be sitting with cash, and then you can see where it gave you a buy signal a little later on, if you see right there, and then another sell signal here, another buy signal here, another sell signal here, buy signal, sell signal, and so on. So if we had used this tool and simply believed in it and used this sell signal and this buy signal, and even if we weren't sure and had ignored these ones, but had said, oops, this is an important one, sell signal, buy signal, we'd have picked up a lot more of the market and we'd have left behind a lot more of the losses. Let's look at the 1939 to 1950 area, and we'll notice that the same thing applies. Now, I just said something a moment ago. What if we left out that little piece? Well, the problem with doing that is you don't know what it's going to do. When you get the sell signal and you're using this tool, discipline is essential, because if you don't take every indicator, if you start throwing indicators out, how do I know, for example, that these indicators were not so critical, but that this one was, or that this one was, or that this one was? I wouldn't. So what I need to do is I need to believe in the tool. If I'm going to use the tool, I have to believe in it. This thing says sell, I sell. This thing says buy, I buy. The net result is next to nothing, but I followed the discipline. Here I sold, here I bought. Oh my God, that was worthwhile. Here I sold, here I bought. Next to no value. Here I sold, here I bought. Great value. Here I sold, here I bought a little value. But the whole point is, if we follow the tool does provide value. But you have to believe. Here's 1946 to 1960. Same thing again. 1959 to 1970. Same thing again. 1968 to 1980. Sideways market. Basically, you started in 1969 at 950 on the Dow approximately, and you finished up at 850 10 years later. However, if you'd used, and you would have made no money, you would have lost money over that 10-year with a buy and hold strategy. Here, with this strategy, you would have actually made some money because you would have been in and out of the markets, but you would have had a net positive result. 79 to 1990, a little tougher because it was a bull market. So here, buy and hold actually worked pretty well. However, the buy and rule, or the rules-based investment strategy, didn't hurt you, and over the long term, it was a safer tool to use rather than just buy and hold. Although anybody that bought the market in 1984, if they just stayed there and did nothing, by 1989, they were pretty happy. Having said that, they had to go through 1987, and that was a stressful period. And this tool would have made that less stressful. Looking at 1989 to 2000, even more so, the market was on a huge run. There weren't too many opportunities to take advantage, but the couple of times that it did tell you to take advantage, if this had turned into a 1929, you would have been protected. So it doesn't hurt you when the markets are doing well, and it can help you a lot when the markets aren't doing well. 1999 to 2010, lots of activity, sideways market again. Here it really helped out. And 2010 to 2016 looks a lot more like the 80s, but even so, it didn't hurt you to use the strategy. So the summary is that, if we look at it for different tools, like there we were looking at it for the S&P, here we're looking at it for gold, and the bottom line is rules-based investing is a safety-first approach. So the idea is, let's not lose money as much as possible, and it'll give us more room to make it. So if capital preservation is key to you, feel free to discuss this with a trusted wealth professional who's local to you by entering your postal code in the wealth professional indicator on the website. Finding stocks to buy and or sell involves both fundamental and technical analysis. So in other words, we want to use technical analysis on stocks which pass the fundamental test. And we'll revisit fundamental and technical analysis in our session entitled Rules-Based Investing. We got a little cartoon here of the economy. So this is sort of like your technical analyst saying, your descent is slowing. Now we'll see if the cord is the right length for your bungee jump. And we can tell by the bounce. This is the end of session 4. We're going to move on now to the commentary component.